So what I'd like to do is really focus this conversation, kind of around practical things that financial advisors would want to hear from you. Today's it's a really interesting time. I mean, the market is completely dominated by capitalization-weighted indexes. If you look at where we are in the market right now, Joel, the first thing I'd like to do to sort of set the table is, what do you think return expectations should be for clients in the S&P 500 the next 2 or 3 years?
Sure. Well, we actually look at a lot of this data. We look at individual stocks, bottoms up, and we've done this for the last 27 years, since 1990. On an individual stock basis, we add them up in the weights of the S&P 500 on a daily basis, and therefore we can contextualize where do we stand today versus those 27 years. And right now we're in the 16th percentile towards expensive over the last 27 years. That means the market's been cheaper 84% of the time, more expensive 16% of the time on a bottom-up basis. Then we can go back and look and say, hey, what's happened from this valuation level in the past? And not as a projection, but to say, what are reasonable expectations? And so what's happened from this valuation level in the past is year forward returns have averaged 3 to 5%, 2 year forward 8 to 10. So that's where we are for the S&P 500. The Russell 2000's a lot more expensive in the 3rd percentile, been cheaper 97% of the time. Year forward returns have averaged -4 to -5% over the next year from this valuation level. So probably most of you know that it is unreasonable to assume markets will continue up 15 to 20% a year ad infinitum, and in fact the valuations bear that out, that the market averaged about 10% annualized returns during the 27 years we looked at, and so we're more expensive, but not negative returns for the S&P 500, 3 to 5% from this valuation.
So pretty modest returns looking forward. Well, active managers have had a really tough time the last 5 years beating the S&P 500. Your Gotham Index Plus product basically beat the S&P 500 by 11% the last 3 years, which is really no small feat. How did you do that in this environment without being substantially overweight tech like a lot of the other managers who outperformed?
Sure, it's very interesting. So Pat asked about something we created 3 years ago called Gotham Index Plus. And it really took a look at, what is the problem for most active managers? The problem for most active managers, and I wrote a book, people have heard me say this before, but in 2011 I wrote a book called The Big Secret, and I always say it's still a big secret because no one read it.
I read it.
And so we hand it out for free here, so in case you got a copy. But anyway, it looked at the period 2000 to 2010, looked at the best performing fund for that period. That fund was up 18% a year. The market was flat during that decade, 2000 to 2010. It's just that the average investor in that fund managed to lose 11% a year on a dollar-weighted basis, meaning the fund was up 18% a year, but the average investor on a dollar-weighted basis lost 11% a year, and you know how it happened. When the market went up, people piled in. When the market went down, people piled out. When the fund outperformed, they piled in. When the fund underperformed, they piled out. They turned that 18% annual gain into 11% annual loss on a dollar-weighted basis, and that is not unique. Also talked about a study in that book for the best performing managers for the decade, the top quartile managers for the 10 years. And half of them who ended up with the best 10-year record spent at least 3 of those 10 years in the bottom decile of performance, meaning to beat the market, you have to do something different than the market. Your returns are going to zig and zag differently. So 3 years ago, we set up, we think we're good active managers, but if people can't stay with us, I wrote an essay on Gotham Index Plus that says the best strategy for you is not only one that makes sense, but one you can stick with. Okay, it needs both of those things. So we said, for better or worse, most people use the S&P 500 as their benchmark. And so we started there, and what we set up is you give us $1, and we go out and recreate the S&P 500 bottoms up with that dollar in the weights of the S&P 500. Then we go out and buy 90 cents, this is all in mutual fund form, then we go out and buy 90 cents more of our favorite S&P stocks, and we short 90 cents of our least favorite. So it has a 90 long, 90 short, long short overlay on top of the dollar we already have in the index. And that's what we use to beat the market over that time. Do our longs beat our shorts? We buy the cheapest, short the most expensive. But we realize that that's a lot of leverage, and the whole idea is if we have a lot of tracking error, meaning we underperform over substantial periods of time, no one will stay with us. So we mitigated that. We made some compromises so that people would stay and capture our active premium. So one thing we did was we made sure the 90 by 90 long short overlay has a 0 beta. okay, because we're already long $1 of the market. Next thing we did is we said, you know, we don't want small stocks driving returns. So if something's 0.01% of the index, we don't want that driving returns because that'll lead to tracking error. So we'll own 5 or 10 times more of that name because we like it, but that's only 0.05 or 0.1%, you know, 5 or 10 times more than what's in the index. The third thing we do is that we actually balance fundamentals. So usually our shorts are trading at 50 or 100 times pre-tax free cash flows. These are hope stocks. People hoping things they'll do better. And if you know in the last 3 years, market's gone straight up other than the last 2 weeks without corrections. That's a very hopeful environment where hope stocks keep getting more expensive, more expensive, more expensive. But the reason people are hopeful is not because these companies are earning money. It's because maybe sales are growing, other fundamentals are doing well. So we balance fundamentals. So you'll see, for instance, that the 90 cents we like have just as good fundamentals as the 90 cents that we don't like. It's that they're just cheaper. They have just as good fundamentals, but they're cheaper. And so we balance our portfolios in those ways to mitigate the underperformance. And when we tested this before we went live, it added 7 points a year to the S&P. And we charged 1% for it, and that was 7% after the 1% fee. We've been live for 3 years, and we haven't done as well, as usually happens, as you know. We're up 3.5 points a year over the S&P. That was good enough to put us in first place, beating out 1,200 funds in our category, including the S&P 500, obviously. Put us in first place for those 3 years. But it's been a very tough period for us because the market went straight up, and people like our hope stocks. So we added value, but not as much as I would expect. Even though we added 11 points, I think we can do a lot better in the next 3 years.
Well, I spent a summer once when I was in graduate school doing a back-tested strategy for Prudential Securities. And by the way, back-testing, it worked great. It was plus 7%. In reality, I think afterwards it was like plus 2. So let's talk about a couple of your largest long positions, Apple, Boeing, Google. Talk about how you value them, how you look at those businesses, and why you think they're cheap. And then I'd like to talk a little bit about a couple of your shorts like Salesforce and Activision.
Sure. So what happens if we really like something? We'll overweight it. We're buying $1.90 of our favorite stocks. We're shorting 90 cents of our least favorite. So Apple's one of our favorites. We have a bigger position even than the index has in Apple. And the reason we're getting a bargain in Apple is because some people think it's a hardware company. We all have BlackBerries, or a lot of us did. And hardware companies crash and burn eventually, and people are worried about that for Apple. On the other side, people say, no, it's not a hardware company. It's a ecosystem of products that play off one another, plus it's a brand name that people like. And so the answer is probably somewhere in between. It's probably gray, somewhere in between. But Apple gushes cash. We're getting it at a big discount to the market. It earns over 100% returns on tangible capital. And we think we're getting a bargain relative to the market. It's far superior company. And the same thing for Boeing. It's a duopoly. There's only one really other competitor. They make a lot of money. We're getting at a big discount to the market. They gush cash, huge returns on capital. Google's also at a discount to the market, growing much faster than the market, much better business, much stickier network. So if you can buy these things at a discount to the market, we don't know if any one particular will outperform, but I always say we don't own Apple. We own a bucket of apples. We own a bucket of companies that gush cash, huge returns on capital, low multiples, nice niches, and that's a very comfortable place to be, very different than the typical value investor. Our definition of value is figure out what it's worth, pay a lot less, leave a large margin of safety, as Ben Graham would say. It's not low price book, low price sales. That's not how any private equity investor would invest in a business because it's trading close to its book value. They're looking at cash flows, and that's what we look at.
Well, talk a little bit about your short positions. Some of your big shorts, I asked you a little bit about Salesforce or Activision, just kind of why you're short those very, very popular stocks.
Sure. So Salesforce, everyone knows it's a good business, but it's trading at 65 times pre-tax earnings. And while sales have grown a lot, earnings haven't. And to pay 65 times for that is pretty darn expensive. They are not able to monetize this in an efficient way. Same Activision Blizzard. They have two, big video games now, Call of Duty and some other one. And, they're doing great, and they're good businesses, but they're trading at over 40 times pre-tax free cash flow, and it's a hit business. And these won't last forever. And so I'm not saying either one of these stocks won't work out. What I'm saying is when we do studies over a long period of time, the very worst strategy you could have is buy companies that lose money or trade at 50 to 100 times pre-tax free cash flow. That's the world's worst strategy. So there will be some unicorns like Tesla or some other names that work out over time. But we're short hundreds of names on the short side, we're long hundreds of names on the long side, and we want to be right on average. And so we're short buckets of companies that just have the worst metrics as far as paying up for hope. 2022 earnings. And historically, we can show that that's the world's worst strategy over time. Once again, stocks or ownership shares of businesses that we value, try to buy at a discount. They are not pieces of paper that bounce around that you put sharp ratios and Sortinos on. And there's always opportunities there if you're cold-hearted and disciplined.
Interesting. So one of the big challenges we have as financial advisors, we're all fee-based fiduciaries. We can control what the client pays in fees. We can control their asset allocation. And to some extent, we can control their taxes. When we hire an active manager, one of the objections is always, particularly an alternative investment like hedge funds and whatnot, is that on an after-tax basis, if you live in a high-tax state, with the turnover in the portfolios, they're terrible. I know that you have personally and your partner over $100 million invested in the Gotham Index Plus. Obviously, you care about taxes because you live in New York City, not the lowest tax place ever. So how do you address that? And what kind of a drag is that on performance long-term for an active manager?
Sure. Well, it's a very interesting question. But luckily, I have a partner who hates paying taxes. I don't know too many people who do really love it, but he really hates them. And so we spend a lot of time looking at this. And we've solved it because we have hundreds of stocks on the long side and hundreds on the short side. So it doesn't matter to us from an alpha generation standpoint whether we own the 7th cheapest or the 8th cheapest stocks out of the S&P 500. So we can take losses when we want. We have hundreds of choices, create short-term losses. We also have an algo that says, hey, you've held this for 10 and a half months, it's up 40%. How much can we let valuation slide, on that particular lot and to hold it for the extra month and a half? And so we have all these trade-offs that we look at. So we actually, really haven't paid any taxes other than dividends in the last few years. And, the fund was up, market was up 12 in 2016. We were up 18, didn't pay any taxes. Last year, we were up 26, market was up 21. We didn't pay any taxes other than a small amount of dividends that you really can't avoid. And because of this flexibility, we can drive this. There's really no drag on return at this level. These are S&P stocks, they're easy to trade. There's not much alpha difference between the 7th and 8th cheapest stock out of 500. So we've been able to solve this, but it's a big, big problem for active managers, particularly hedge funds, because people look at pre-tax returns, and that's how they sell things. And because we're real investors in this, it matters to us a lot. We look at things on after tax, so we have a big advantage.
That's important. When we were talking before, we were talking a little about just kind of generally about your views on the stock market and how companies have changed, how they use capital differently. Would you talk a little bit about that? Because I thought it was really interesting what you were telling me about why companies are so profitable and how the life cycle of companies today is shorter.
Yeah, this is a fascinating period to be living through. We've done a lot of work, and all of you know the rate of disruption is just increasing. And one of the things that's interesting on the use of capital is we took a look at 20 years ago. How much capital, tangible capital, working capital and fixed assets did it take to make $1 in sales? And 20 years ago, it took 55 cents of working capital and fixed assets to create $1 in sales. Today, that number is 23 cents. It takes 23 cents in working capital and fixed assets to make $1 in sales. What does that mean? It means that you're not building factories to make money anymore. You're basically paying for network effects and good ideas and things of that nature. What does that also mean? The demand for capital is lower, meaning businesses, they don't want your money as much. You're getting paid for good ideas and creating networks and low asset-like businesses. And so, that could indicate that although I think interest rates are subnormal, the demand for money will remain fairly low, and the premium will be on good ideas. And if you take a look at the S&P 500, whether it's Apple, which doesn't really have most of its own factories, or Google, which is really an internet platform, and even Boeing, where they can outsource a lot, they have huge returns on capital. So it's really fascinating. what's been happening and the amount of disruption that's going on. And I would argue that disruption is happening so much faster that you sort of have to earn higher returns on capital because your time in the sun is actually shorter than it used to be. You know, Warren Buffett made his money owning newspapers and broadcasters, and those were the great businesses with the great monopolies and franchises, and now you know what happened to those businesses. So your time in the sun is actually shorter than it was, and so I think this is the way of the world, and you have to stay on your toes.
In other words, you know, having an active component in portfolio is going to matter going forward, especially if the rate of disruption picks up. Do you think that some of the changes coming with artificial intelligence, what's coming out of Silicon Valley, will even increase the formation of businesses will be even faster, and the destruction of businesses will be even quicker than in the last 5 or 10 years as these new secular trends take hold?
Well, it's tough to know on the. I think there'll continue to be disruption. We've had a real problem, actually, in the formation of new businesses. There's a certain type that Silicon Valley will fund, but you know, with all the regulation on banks and small banks not being able to compete and deal with it, there's lower loan ability. You know that the Wilshire 5000, an index of 5,000 public companies, only has 3,500 companies in it, because that's all the public companies there are. When I got started, there were 12,000. That means, you know, I sit on a public company board. It's a small public company, but their expenses for being public are about $3 million a year. That means that if you have 10 million in profits, not sales, but 10 million in profits, you would have to take 30% of your profits and, you know, just pay for being public. So you can tell a lot of good businesses can't even use the public markets to go public. So I think this whole deregulation thing's got to go a lot more than it has. There's smarter ways to do it, and that's a pet peeve of mine. I'll leave it at that.
Good. We've got 1 minute left, Joel. You know, what advice would you give financial advisors, you know, advising their clients on how to think about portfolio construction over the next decade?
Well, listen, I think the move to passive is here to stay. I gave a speech at Google a few months ago, and I started it this way. I said, even Warren Buffett said most people should just index. And then I said, I agree with him, and I left. Well, I didn't actually leave. What I said was, well, then again, Warren Buffett doesn't index, and neither do I. There's huge opportunity. I've been teaching at Columbia Business School for the last 22 years. And every year my students somebody raises their hand and says, hey, Joel, isn't the party over for us? There's so many managers, there's so many computers, there's so much data, you know, all this stuff. Isn't the party over for us? And so I tell them that, you know, they're 27 years, they're second year MBA. So I said, let's go back to when you learned how to read 20 years ago. You were 7 years old. Let's take a look at the most followed market in the world, the United States. Let's look at the most followed stocks within the most followed market in the world. Those would be the S&P 500 stocks. Let's take a look at what's happened since you learned how to read. And I said from 1997 to 2000, the S&P 500 doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. From 2009 to today, it's roughly tripled, which is my way of telling my students that people are still crazy and very emotional. And if you're cold-hearted and disciplined, and you believe what Ben Graham said, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined strategy to value companies, and once again, stocks are ownership shares of businesses, and buy more than your fair share when they're below the line, and sell more than your fair share if you're so inclined when they're above the line, you know, or short them, the market's throwing us opportunities all the time. There are behavioral problems, there are agency problems. There's a lot of reasons why active managers, on average, don't beat the market. But they're a minority that can, and the market's a very emotional place. If you are cold-hearted and disciplined, the opportunities are there. We try to stay very disciplined. There's an opportunity. It's just that you have to find that active manager. You have to understand what they're doing. You have to stick with them during those periods, right? To beat the market, you have to do something different than the market. Your returns are going to zig and zag. And so I started out with that fund that outperformed 18%. But people underperformed even, you know, by 11, you know, lost 11%. I mean, underperformed by 29%. They didn't capture it. And so that was the idea behind Index Plus, make it easier for people to stick with an active manager, but it's going to be a hard challenge. So I believe the move to passive is here to stay. There is a window for active managers, but it's going to be a minority, and it's going to be harder. And it's actually, as an active manager, I say this not for my own book, it's actually not a bad thing for most people. Passive is the right thing if they don't know anything. But if you know what you're doing, there is a lot of value you can add in the active space.
Thank you, Joel. Thank you.